Thank you so much for having me and for putting the paper on the program. It's a great pleasure to be here. This is joint work with Glenn Schepens. And since we are both at the ECB, now I need my goggles because the views expressed in this presentation represents those of the authors and not necessarily those of the ECB or the Eurosystem. So in recent years, we've seen central banks step in as market maker of last resorts when markets freeze. In this paper, we trace the whole cycle of such an intervention, from stabilizing the market to what happens once the central bank steps back. Let me start by showing you what happened in the euro area commercial paper market in March 2020, which is the starting point of our analysis. Before I go to the nice chart on the right, let me define what is a commercial paper. It's a short-term unsecured debt, maturity below 1 year. It's issued mostly by large firms that are sold to buy and hold institutional investors. And firms use commercial paper to manage their short-term funding needs, so paying wage bills, for instance. In our sample, in fact, commercial paper are 32% of the short-term debt of these non-financial corporations. Turning to the chart on the right, what you see is the number of issuances of commercial paper by non-financial corporations. And on the y-axis is the number of issuances, which are on a weekly basis usually around 200. But in March 2020, they go down to below around 50. Independent of what metrics we look at in the commercial paper market, you will see a similar pattern. For instance, looking at the number of issuers that are usually around 100 on a weekly basis, they go down to about 40. Even more stark so, on the right, the volumes of new issuance. New issuances in terms of actual aggregate volumes, which are usually around 9 billion, and they go down to about 1. So there was a sharp decline and a collapse of this market. Now, this nice dashed line here in the middle is just before the ECB started buying commercial paper. And what you see is a revival of the funding to firms just after. So, in an unprecedented move, the ECB started buying the NFC commercial paper as of March 26 and stated the objective to improve monetary policy transmission, preserve reliance on market-based funding, free up bank lending capacity, and foster market confidence. So in this paper, we try to study the full cycle from market collapse to the central bank intervention and eventually to the central bank exit and its impact. Specifically, we asked the questions, why did the commercial paper market suddenly collapse in March 2020? Could the firms substitute lost commercial paper funding via bank credit lines? How effective was the ECB's market maker of last resort intervention? And what happened after the ECB exited? This provides a unique setup because a nice feature for our study of commercial paper is that it has very short maturity. And the ECB, in fact, no longer holds a commercial paper. So we can look at the exit vis-à-vis other asset classes as sovereign bonds, for instance, where quantitative tightening is ongoing. We also have very granular data on firm level that we complement with ECB holdings of commercial paper, so we can study the effects of the market maker of last resort intervention, as well as the bank credit lines to firms to study the substitution between market and bank funding. And we also know who holds commercial paper both before and after the intervention. So to understand the collapse, we look at who is the main investor in this market. It turns out that money market funds played a dominant role, and their behavior, in fact, explains much of the collapse that happened in March 2020. In fact, 60% of all commercial paper was held by money market funds as end of 2019. So what happened to money market funds in March 2020? What we see here is the aggregate net fund flow. The net fund is the difference between inflows and outflows. And what you see in March 2020 is a sharp decline, large outflows in money market funds. Also, after the intervention, the flows didn't come back. So it stayed for quite some time on this level. During this crisis, money market funds, in fact, did not roll over their commercial paper. So now we have to put this into a regression setup and into an empirical framework, this observation. So what we do, we focus on the relationships a firm had with different money market funds prior to the market collapse. So what we need here is firms with more than 2 money market fund relationships, because that way we can control for firm demand in the quasi-Mian sense. And the feature of commercial paper helps us here because typically commercial paper issuances are absorbed by a particular money market fund in full. There's a very concentrated ownership here. So this is a different diff setup that compares commercial paper holdings issued by the same firm across money market funds facing negative versus positive net flows in March 2020. And this is what you see in this regression setup. On the left-hand side, we have the log of outstanding commercial paper on a firm money market fund basis. And money market funds with negative flows, this is what you see here, reduce their commercial paper holdings by 13 to 23%, depending on the specification, column 1 to column 3. All right, so naturally the question is, could firms replace the lost market funding with bank credit? And this is what we look at next. First, we analyze how credit line take-up relates to the commercial paper gap. What is the commercial paper gap? It's the commercial paper maturing minus new commercial paper issuances. So if there is less issuance than maturing, it's a positive gap. A positive correlation will mean that there is a substitution between the bank credit lines and this commercial paper gap. So what we find is that firms with a positive gap could only replace about 27% of lost market funding via bank credit lines, or if you want, 27 cents on the euro, which you see here in the second column. So soon after, the ECB stepped in through the PEP program, and it began buying commercial paper, which is an unprecedented move and did not happen before. So let me review just in 2 bullet points the pandemic emergency purchase program, which was a temporary asset purchase program as a response to the COVID-19 turmoil, and it was the first ever program that included commercial paper purchases. And in fact, during the first month of the PEP, 73% of all private debt purchases were commercial paper. Now, as I told you before, there is the investor base is not as diversified. So what the central bank ended up with is buying on the primary market. 81% was in fact bought on the primary market. And as for bonds, of course, the commercial paper had to satisfy certain eligibility criteria. and it was announced on March 18, 2020, and the actual purchases started on March 26. So thinking about what happened to the main investors. So this is the main investor being the central bank, and what you have here, the central bank holdings of firms' commercial paper in percent. This is taking the firm's view. This is the average holding of commercial paper that was held by the central bank. And you see at the peak, around nearly 80% on average was held by the central bank. So it was a big intervention. And you can also see that right after it declines quite quickly because of the short-term nature of these debt securities. Also, what you see is by 2023, everything was over and the central bank exited. So now we want to put this again into a regression. So the empirical setup is really that we analyze the impact of PEP purchases on volumes, maturity, and yield of commercial paper. And we have this diff and diff setup where we compare PEP impact across eligible versus non-eligible commercial paper securities. And the sample period here is 4 weeks before and 4 weeks after the ECB started buying these securities. So putting this into a graph, what happened? So if we split by those commercial paper that are eligible versus those that are ineligible, what you see is, and this is the blue line, these are the change in amount outstanding relative to before the crisis for eligible commercial paper. And you see that with the intervention, they started going up. But let me draw your attention to the crisis period and before the crisis period, because here both lines go remarkably close to each other, even during the crisis time, where the non-eligible and the eligible both declined. And you can put this also differently in a different metrics, where you have here on the left-hand side the new issuances, and there you can see on a weekly basis, in particular during the crisis, there is a very nice parallel trend. While after, there is this gap opening, which is due to the eligibility. So putting this into a regression, what we have here on the left is the log volume per issuance, and this goes up by about 50%. If we use this and we look at the actual aggregates, that implies a volume increase of 4 to 6 billion, while for the ineligible, it continues going down slightly. What about maturity? Maturity, in terms of days, increases by 70%, and it goes up from 109 to 146 for eligible. For non-eligible, it goes, in fact, down during this period from 91 to 59. Also important is, of course, the yield. Did it have an impact on the yield? Let me start with column 2, where we look at commercial paper below 1 month. And we do not find a significant effect. And in fact, this is not surprising, because the minimum requirement was 30 days. So these were not eligible. While we have a negative sign here in the 1 to 3 months, in the 1 to 3 months, and we see that most issuances happen there, and the funding costs decline by 13.8 basis points. Now, as a final step, what happens once the central bank leaves the market? In fact, the short maturity of commercial paper allows us to study directly this quantitative tightening. Our analysis is around the impact of the exit on commercial, and we regress on commercial paper yields and maturity and commercial paper holdings by money market funds. We'll also look at the new relationships a firm develops. And this diff setup compares the impact across firms with higher versus lower reliance on the central bank. Now, higher versus lower reliance is a definition whether during the PEP episode, you as a firm were more reliant versus less reliant on the central bank interventions. So we can include here time-fixed effects and firm-level dummies for the distance to the ECB exit. So the variation we are left with is this staggered nature event on exit on firm level. So here we look at the yields and maturity. Column 1 shows you the yields. Column 2, the maturity. The less reliant firms had an increase of about 13 basis points compared to pre-COVID once the central bank exited. The more reliant ones had an increase of an extra 20 basis points. So the levels were somewhat higher. Actually, this estimate you don't see in this regression. But the levels were somewhat higher once the ECB exited in general. It's a different, it has nothing to do with the ECB exit per se. But what you have here is that the more reliant firms, they had an extra 20 basis points. We see no difference when it comes to the maturity. While, let me point you to the period during the PEP, there was no differential in the yield between those that were more reliant and less reliant. They had all access to the intervention. Now, money market funds did come back. So what we look at here is the differential between more reliant and less reliant firms. Money market funds came back, took over the shares the central bank was giving back to the market. But what you can see is that those that were more reliant at the peak, they in fact, their money market funds held around, on average, 183 million less. The same is true for new relationships. This market is much more relationship-based, or is relationship-based. So a natural question is, could they, after the ECB stepped in and held a large share of these securities, could they build up new relationships with their investors, with their money market funds? And in fact, what we see is that 3.7 fewer relationships were made after exit compared to those firms that were less reliant on the central bank. Now, what about credit line drawdowns post-crisis? What we look at here in column 1 is the lock committed amount by banks to firms. And what you see is that during the COVID crisis, these committed amounts went up by about 50%. Non-surprising, they all wanted to have more larger credit lines. Now came the PEP. These credit lines, however, continued going up. So there was this precautionary behavior. Even after exit, these credit lines are about 70% higher than pre-crisis levels. What about the drawn amount? That is an interesting one because during the COVID crisis, firms were also trying to get liquidity, and they were tapping into the credit lines. In fact, a threefold increase in credit line usage during the crisis, and it immediately went back to pre-COVID levels once the PEP started. In fact, here, one of the intended effects was to free up bank lending capacity, and this indicates that this worked well. We can put this together and think about what about the undrawn amount? The undrawn amount is growing with PEP and even after the ECB exits is still very large. So in this paper, what we do, we study the full cycle from collapse to purchases, then to exit. So the collapse of the commercial paper market was driven by the runs on money market fund, which are by far the largest investors, holders of commercial paper. And they faced unprecedented redemption in March 2020. However, only 27% of lost market funding could be replaced via bank credit lines. Then came the ECB and intervened, and the effects of the market maker of last resorts were that it improved the monetary policy transmission to firms. The yields, in fact, went down, issuance and maturity went up. And it reduced credit line drawdowns of these firms and freed up bank lending capacity. Now comes the exit of the ECB. Firms that were more reliant, in fact, on the intervention faced more challenging market conditions with higher yields, less money market funding, and fewer new relationships. And with this, I want to thank you, and I look forward to the discussion.
Thank you. Over to you, Olivier.
Thank you. Great presentation. I have no legal obligation, but I feel pressure to say that these are my views, although I hope by the end they might also be some of your views. So I'm very glad that the organizer asked me to discuss this paper. It's super interesting. This is a topic that is incredibly close to my heart, direct intervention by central banks or asset purchases. I think it's perhaps surprising that it's almost 20 years that we use these policies now in Europe and the US, and there's still so much to learn. So I think this paper is a great example of that. What I'm going to do today in the discussion is to actually try to bring a broader perspective on, I think, what we know or what we think about asset purchases and how this paper fits into that broader narrative. So I think when they started, asset purchases were labeled as unconventional monetary policy. I think at this point, this is a misnomer. This is no longer unconventional. All central banks across the world routinely conduct very large-scale asset purchases program and have done so for years. And today, Isabel's actually talked about new ways that they're thinking about doing structural asset purchases. So I think these are here to stay. So what are these assets that are being purchased? Let's be very concrete. These are overwhelmingly bonds and safe bonds at that. Commercial paper is kind of rare. It's kind of a little bit different, being extremely short-term and issued by corporates. So there's going to be some interesting things to see how that fits in the broader picture. And Johannes touched a little bit on that. Specifically, the paper is going to look at one really interesting program from the ECB, commercial paper in Europe in spring 2020. So again, I'll take a step back in the discussion and try to look back and give a broader perspective on asset purchases and how they work, and then we'll see how the specific intervention comes in. Okay, and I think the paper of Johannes and Glenn is really, really interesting in thinking about the entire cycle. Specifically, I'm really going to try to tell a story, trying to see exactly how asset purchases work. So once upon a time in Frankfurt, there was a small asset purchase program. And when I'll do that, I'm going to use sometime a little bit broader and bolder statement, perhaps, that Johannes and Glenn can when they have to write a serious academic paper. So if you think it's too controversial or you disagree with what I say, feel free to chase me at the breaks and tell me what you think. I think this is interesting things to discuss. Like every good story, there are three acts. There's a beginning, the announcement, a middle, the scaling, and an end, the exit. And I think it's a great thing about Johannes and Glenn's paper that they do go through the full cycle. This is super, super interesting. And again, I think there's a lot to learn about that, even when you think about the problem more broadly. First act is the announcement. So at the beginning, there was an evil dragon. Did I say dragon? Much worse. There was stress in the money market. Much worse. I see everybody recoiling in their chair here. In a macro seminar, people might start to fall asleep, but I'm glad that you actually understand the gravity of these things. So you've seen a version of that picture, commercial paper market collapse in Europe, and with the ECB intervention and announcement of a specific program to buy this commercial paper, the market rebounded. So this is interesting that I like to think about asset purchase program. It's typically having two sorts of objectives. So I think this is more of an asset purchase program of the second kind. Okay, I'm a big fan of Spielberg. There's like Close Encounter of the third kind. Apparently there's different kinds of encounter you can have with aliens. Well, it's the same with asset purchases. This is the second kind in the sense that it's responding to market turmoil. It's a market maker of last resort, using the words that Johannes used. Okay? Now, not all asset purchases are like that. I think it's important to see that. For example, the first 3 waves of QE in the United States was much more about providing kind of additional stimulus to the economy when you hit the zero lower bound, and you've done a lot of other policies. Okay, so I would call this asset purchase of the first kind. Now we're still learning about exactly how does that work, and it's a fascinating question. I think asset purchases rest on the premise that there's some imperfection in financial markets. In financial market, we're perfectly integrated, incorporating information perfectly and things like that. There really wouldn't be much role for asset purchases. You could do a lot with conventional tools. Okay, so that's kind of a paradigm shift for monetary economics in terms of thinking what are the channels. Okay, and I think the channels are very different from traditional frictions that are kind of in more classical monetary models. I think asset purchases, especially of the second kind, are trying to distort prices, but in the right way, right? If you have frictions, they can be financial shocks that are going to distort prices away from fundamental. And so the point of the program is to put them in line with fundamental. So you want to cancel financial shocks without undoing fundamental shocks. So that's how I think at a high level what a lot of these programs are trying to do. Now channels. Channels are tricky. In my mind, I like to organize it in like 3 broad channels. The first one is a very mechanical one, is buying up supply. To some extent, the demand curve, for some of these bonds sloped down, and if you buy more, the price is going to move. Okay, that's kind of very mechanical. The second, I would say, an expectation channel is about thinking about the first channel, but like anticipating it. So in the future, if I know the central bank is going to buy some bonds and the price is going to go up, then today the price might go up already. Okay, so it have information about future policy support. And then finally, crucially, especially for this kind of intervention, an intermediation channel, right? When you have imperfect financial markets, intermediaries are going to naturally arise to try to alleviate these frictions. And so a central question is, to what extent asset purchase affect the provision of intermediation? We would like to think that they can help them, but perhaps there's possibility in which they can hurt them. Okay, and so today, the paper of Johannes and Glenn talks a lot about specific form of intermediaries, which are money market funds, and whether the effect was all entirely positive. Okay, I've done some works on banks before, insurance, mutual funds. There's a lot of things to think about here about how asset purchases affect the provision of intermediations. Act 2 is scaling. So here, one observation that I often make is how often, if not always, these programs end up cornering the market. You've seen the graph on the left already. At the peak, the ECB is holding 80% of the papers issued by this firm. That's an incredibly large amount. In other markets, there's also very large holdings. So on the other side, you can see corporate bond holding by the same ECB. At the peak, it's in green here. The Euro system holds almost 30% of the market. This is the largest investors class. Okay, so that is not uncommon. Now, I think the one channel by which you get to such large scale is something that I call the expectation ratchet effect. Okay. The idea is that the expectation channel, the second one, kind of loses power over time as intervention becomes expected. And so it doesn't really mean that this channel is weaker, it's just that it's kind of mostly priced in already. Now that means that you have to rely to increase price further beyond expectation much more on the mechanical first channel of buying up the supply. You have to kind of buy more and mechanically go through the order book much more aggressively. I think one way to see that is to look at the Fed balance sheet, actually, and what happened in 2020. In spring 2020, there was turmoil in both corporate and treasury debt markets in the US, so the Fed started 2 programs to support each of these markets, asset purchase program. And it's just striking how the response of these 2 programs went. The first, the corporate bond program, was actually very new. It was actually the first time ever the Fed bought some corporate bonds. The ECB had started to buy corporate bond earlier, but the Fed didn't. And this had a big announcement effect on the corporate bond market. So large was the market rebound that in the end the Fed essentially bought very little. They bought almost nothing. Contrast this with the Treasury market program, a purchase program, that is nothing new, it's the same usual thing, and was, in spite of the large scale of the announcement, there was almost no reaction immediately. And so instead, to move the price up, the Fed had to buy tons and tons of Treasury in what we now sometimes call QE infinity. That's the big jump that you see here, where in a few weeks the Fed bought almost as much as they bought in their entire previous existence. Okay. Now let's think about exit. And I think it's great that this paper is actually being able to look at exit directly. There is more exit happening, and there's a lot of question mark about that. Specifically, there's some concern whether with exit can come trouble. And so I'll talk about 2 types of potential worries. The first one is coming with quantitative tightening. And I agree with Isabelle that this is not a great word, but the tightening comes with this fear. This fear that as you unwind balance sheet, there's going to be a new taper tantrum. I think that is not necessarily the case. And I think the evidence supports that overall. I think by now we understand that asset purchase program are counter-cyclical policy. And so when you scale them down in good times, you're following the rule. You're not breaking it. I think if you can communicate clearly this, I think the risk for financial stability is actually minimum. Okay? I'll do a little parallel with conventional monetary policy here for a second. Conventional monetary policy has a long-term objective, price stability, and an imperfect instrument, short-term interest rate. The way it tries to reach the objective of its imperfect instrument is by trying to credibly and clearly commit to a path, a state contingent policy rule. Well, perhaps by now, unconventional monetary policy is no longer so unconventional that there's a bit of analogy. The long-term objective is financial stability, the indirect instrument is bond purchases, and there's a state contingent rule, but it's in quotation mark, it's a little bit more implicit. So perhaps there can be some gains to try to address this potential worry about QT, that perhaps they could be more clear and credible commitment to a path. A little bit what the structural asset purchase of Isabelle already today, laying out the plan for future years, is a kind of a clear example of that actually. So I'm happy to see that. The last potential worry with exit is kind of the last result that Johannes talked about, which I think is really fascinating. Is this idea that potentially it can damage relationships. And there I want to do another parallel with traditional credit crunch. The usual way when there's stress in traditional bank loan market is that policy support will be focused on the liability side. That's the lender of last resort policy. That's where the market making of last resort comes in. It comes from very different style by attacking the liability side. There's a little bit this notion that perhaps we should not mess too much with the asset side because intermediaries in the end were the one that were created to try to be good at lending. And lending directly perhaps could hurt relationships and hurt capital allocation eventually. I think that matters most in primary markets where lenders and borrower actually meets and funds are actually exchanged. And this is why I think a lot of asset purchases program are tilted towards secondary market to try to let underwriter do the job. But here commercial paper is really fascinating because the market maturity is so short that essentially everything is primary market. And so these intermediaries, which are here are non-banks, in fact in this paper they are money market funds, the fact that they actually are doing lending on the asset side end up being important. Relationships exist and are perhaps more important than you might have thought going in. So I think it's important to think about non-banks when you think about asset purchases. I think that was a point that wasn't clear decade ago when these programs were being developed and being used. I firmly believe that asset purchases often help the asset side of non-banks, and there's still a conceptual question about whether they're preferable to more traditional lender of last resort liability targeted policies, and we should at least think about them as a joint problem. Okay? I'll just end by a statement that I feel very strongly about, that I think this paper shows very nicely, but I think hold much more broadly, which is that in the end you can't fully understand the effect of asset purchase program if you don't understand non-bank lending. The new forms of intermediation that have done more and more, especially of credit and lending to firms, what are their balance sheets, what are the frictions that they face, but also the frictions that they alleviate. And to understand fully the effect of the policy, we need to think about very carefully about these new forms of lending. Thank you so much.
Thank you very much, Olivier. Very interesting. So now we have about 10 minutes for Q&A. So please put your hand up and identify yourself. Again, thank you. And there's a microphone coming along here.
Johannes, yes, a very quick question. Eric Scotto Di Rinaldi from Rabobank. If I understood correctly, you attribute the increase in borrowing costs to the firms that used to be or became ECB eligible for their issuance, to the exit of the ECB as a market maker of last resort. But the question I have is, has the paper, or have you in your analysis considered how the riskiness of these firms changed between being before the ECB eligibility and after? Because one of your graphs does show that the issuance volumes did increase, but it's not clear to me that their balance sheets have remained as sound as they were before. Thank you.
Yeah, so maybe I'm going to answer very quickly. Yeah, so we look at firms more reliant versus less reliant. They are all reliant. So even in the group that are less reliant, around 65% in fact at the peak was held. This is the average of the less reliant group. Now, what you're saying is maybe those were more risky, and the money market funds didn't want to hold those commercial paper, and so exposed we have a differential in relationships. So yes and no. So I think what we see is very nicely that the firms are all purchased, and actually the difference between reliance is relatively small, in the sense that our control group is not firms that are not reliant at all. What I want to rather think of, you have some that are reliant to nearly 100% on the central bank at their peak. So their relationships are completely cut off. And if you think about relationships that they have to form anew after exit or during the QT period, QN period, and then indeed there's this extra challenge. So this is how we think about it.
Other questions? Maybe while you're forming your question, I could ask one, Johannes. So I liked how in your study you highlighted the flight to safety by the money market funds during the crisis, and they reduced their exposure more significantly, as you say, to the small and COVID-exposed firms. So do you think that the central bank's intervention had any effect on reversing that behaviour, or was it really that PEP was simply replacing a missing source of liquidity?
So the views expressed are those my personal views. So I think the market was indeed replaced by a market that didn't exist anymore. So what you really see is that in the crisis period, money market funds, the prime investors, they simply stopped rolling over. It was the first. It's much easier than selling something. If you face redemption as a money market fund, the first thing you do is not reinvest whatever is maturing. And this market basically didn't exist anymore. And the central bank stepped in and took for some time, took over the market. But then actually, because the nature of these securities is short term. The exit was there very, very quickly. So it was effective and it was quick.
Yeah. Another question? Isabel. Yeah. Mm.
Just a very quick follow-up. Were you surprised by the fact that only 27% of the...
Right, you have to.
Microphone is coming. Yeah, it's here. Yeah.
Thanks. Yeah, no, very interesting. I just wanted to follow up quickly. So to what, were you surprised by the fact that the banks only stepped in 27% of the foregone funding?
Yes, this is a
and what is your explanation for that?
Yes, so everybody was scrambling for liquidity in March 2020, right? And as you can see that the credit lines, they were used, right? So the credit lines actually, so the drawn credit increased by 3 times the amount as it was before. So the credit lines were important, but they were not enough. And firms also tried to renegotiate, and this is what you saw, that these credit lines actually increased, but they increased still not to enough levels. So that's what we saw, that 1.27 cents on the euro could be replaced, but not more, right? So in the end, that's why I think, again, it was quite an important step for the central bank to step in and to make sure that this market it recovers, or the funding to firms recovers very quickly, because this was really at the heart of the firm. They couldn't pay their bills. This was as close as to real effects, I think, as we could get here. Oh, sorry.
Yeah. Sebastian? Yeah.
Hi, Sebastian Infante from the Fed Board. Very interesting paper and discussion. Thank you. I just had a clarifying question on the overall market. Was there a loss were there a lot of defaults? I mean, it's probably a very hard thing to answer because there were probably support from many other places. But I mean, was this truly a liquidity issue, or was this a credit issue? Any comments?
Yeah, excellent question. So what we know is that these are large European firms, and there was no risk of default in this sense. So the issuances, well, there's always, right, but but not on this level, that if so that the riskiness would have mattered for the money market funds to stop rolling it over. So these are really the large European firms.
Yes. Ileana Pietraru from Societe Generale. I'm a treasurer for the bank. I remember 2020 when you say that liquidity vanished, it was actually a problem of maturity, because I remember we had all very short liquidity that was stacked up on our balance sheet. So it was a deep transformation between term liquidity and short-term liquidity, actually. Did you factor that in your research or in your paper?
So in what sense would it?
Well, there was liquidity did not vanish from the system, right? Obviously, it was still there. It was just instead of being invested in the medium term with the banks, right, it was left in overnight, roughly. So it was, right, there was a disintermediation between corporate money market funds and banks, but ultimately liquidity did not disappear. It was on the balance sheet of banks in very short term.
Absolutely. And there was a lot of liquidity in the market because everybody tried to get a hold of as much liquidity as possible at this point in time. And for money market funds, this was the way to get liquidity is to basically get rid of the commercial paper, to not roll over those, and to hold on so they don't have to sell the more longer term securities.
Thank you. Thank you.
Any more questions? Yeah, near the back.
Yeah, so thanks for the presentation. It's Stefan Kreppmeier from the Bundesbank. So I would like to go again forward to the exit results, which I think are very interesting. And I was wondering to get your opinion on to what extent the other big monetary policy movement, namely the hike in the rates, might have played a role in explaining the results, given that, among other things, money market funds benefited from those hikes as they received large inflows, in particular coming from households. So could it be that the investor base of the money market funds, combined with some kind of matching to the commercial paper issuers, also played a role in explaining the differential yield effects?
So what we see exposed is that the yields are somewhat higher in general when we compare it to the pre-period. But further than that, the paper doesn't go. So we really try to make sure that the level is controlled for, while we want to look at the differential. So what we find is this differential is important to tie it to this reliance on the central bank during the intervention. We don't really go further than that.
Okay, so I think we'll draw this session to a close. Many thanks to all of you. That's been really interesting. I must say, as a central banker with responsibility for monetary policy implementation, analysing and researching the effects of our actions and interventions, I'm struck by so much learning to take away, and learning from both the US actions and European actions. So very much appreciative of that. So with just the information that we have a coffee break now until 11:30, and then our next session. But please show your appreciation again to our excellent discussants.